Xero, it's accounting software.
Little things that do make it great, though. Xero's bank recs are different.
So the biggest thing with Xero is you can't journal cash. That's the plague of accountancy. If you can't...
The plague of accountancy.
Because doing a journal entry means you're not fixing the problem. You're creating a problem down the road. I'd never liked journal entry tasks in QuickBooks.
I grew up in a house that banned QuickBooks.
I thought you were going to say made of a GL, like a GL house. Everything you did, you had a
I like where that's
entry.
Going. I like
so when
where
you
that
took a right
metaphor
step,
is.
there was a left step too.
Ooh, so everything
when you opened
we do,
one door closed.
Yes, so that's a good metaphor to drive away with Xero. Like if you make a decision in Xero, it does have to have an equal. Every reaction has an equal reaction. What's the phrase there? You should
that's
do
one
in a
of
GL.
Newton's laws of physics, but
Newton's law of Xero is like you can't just make shit up like you can in QuickBooks. Stuff it in equity, stuff it in retained earnings.
And I find it a lot easier to fix. Like at the end of the year when your clients give you stuff,
there's controls in place. So the controls in place, I think, are forcing mechanisms. Creatives say that creative controls make for a better outcome, a better result. I think that's also what Xero is. If you have the controls in place, it's going to be frustrating. It's going to be hard in the beginning, but the end result is going to be beautiful. And right now, they offer free conversions from other accounting platforms.
Yes, that's the best thing too. Is like they make it easy to convert from QuickBooks Online or QuickBooks Desktop or Sage. You use Jet Convert; it's free, and it works
free
great.
Jet Convert account.
Go to Xero.com.
Go to Xero.com. Check them out.
I love it.
It's patience and perspective over perfection.
Yeah,
that's what I worked out based on what you said. Like, you know, it's never going to be perfect. So have some patience to experiment with stuff and figure out what's going to work.
Perfect. They try to do everything perfectly.
Yeah. Mm-hmm. But in the perspective, the longer game and the longer perspective on what's the downstream impact of not doing it versus just doing it. Like, what's the worst that could happen if it's not perfect?
Exactly. I think you summed that up perfectly. Yeah, that's because everybody can do it. It's just a matter of, do they want to take that risk? Because it's a risk. It's different. It's fear of failure.
Hello and welcome. We are all the sons of CPAs. Join us as we question the current state of the accounting and tax industry with the next generation of professionals leading this space. We are all the change agents in an industry fraught with money and inertia. Let's begin the Sons of CPAs with your original hosts, Jason Ackerman and Scott Scarano.
And we have a guest today.
We do.
Like we have every week.
Like every week. Jody Grunden. Ackerman doesn't like pronouncing names because he always does it wrong.
I feel like Jody Grunden I could have got. Jody, welcome. We're glad you're here.
Yeah, thanks for having me.
And you live in Indiana.
Yes, I do. I live in Indiana, and then the firm's really, it's completely remote. So we're spread throughout the whole United States and have some team members abroad as well.
There's a lot of accounting forward thinkers in Indiana. Isn't that where Darren Root?
Yeah,
Indiana.
Southern Indiana. Yep.
So there's something going on in the water in Indiana.
I'll start off by saying I think your firm is the model. I don't know, like in my head of how a firm should be run and everything that I would like to do with my firm, if I had something to model off of, it would be Summit. Ultimately, everything, the more I learn, the more clear the picture gets on what my vision is for our firm, or just what I think are the good ways of a firm. So I'm just going to start off with that.
He says this to everybody, but
I really don't.
For you.
Tell us how you became a CPA, I guess.
So how I became a CPA, not a son of the CPA, unfortunately. Actually, I'm the first person in my family that went to college. So I could say I come from a completely different background altogether. And how I became a CPA, when I was at IU in Indiana University, I was trying to think of a way that I could, a profession that I could actually do if I decided I didn't want to work for somebody. And I thought stockbroker or something like that would be kind of cool. And then I realized, well, if I did that, I had to probably move to New York or some big city. I didn't want to do that. And so I thought, well, an accountant, I could actually be an accountant. I think that would be something kind of cool. And if it didn't work out, I'd have something to fall back on personally And so that's why I chose the CPA route. Had there been classes on entrepreneurship at that point, I probably would have went that route, because that's in reality, that's truly what I am.
So, care to share how long you've been doing this? How long have you been at this?
Yeah, so I took the long route through college. It took me about 7 years. I basically worked full time for the most part. And,
IU's fun, man. I get it.
Yeah, it's a great, awesome school.
Bloomington. I've been there.
For sure. And, basically I went right out of college. I worked, it was about 94, 95 is when I graduated, somewhere in there. Worked in public accounting for about 3 years between Crow and BKD. And then I went to the private world. I decided I didn't want to do that public accounting stuff, and decided the private stuff was where to go. And I did that for a $250 million manufacturing company for about 3 years. Thought paint was going to dry. It was the worst experience ever. It was so boring. It was like Groundhog Day over and over and over again. And so it was one of those things. I thought, well, I don't like public accounting and I don't like corporate accounting. Now what am I going to do? And it just happened. I got an opportunity to work for a firm. I worked for them for about a year, left the corporate world, worked there for about a year, then decided, hey, it's time for me to go out on my own. And soon after, I went out on my own. So in 2002 is when I actually started the firm. Kind of basically hired my current partner right now. I hired him right out of college. And so it was one of those deals that we kind of started together, kind of made the firm the way it is right now.
So there we go. Partner. That was one of the things. So is it Andy? Andy Hale?
It's
Adam Hale.
Yep.
Sorry. I knew I was going to get it wrong. I was going to say Adam, and then I went to Andy.
Nope,
so Adam Hale.
Yep.
So what is, I guess now let's what's your role in the firm and what's his role?
Yeah. So our firm is kind of a non-traditional approach in really every way you can think of. The fact that we're completely remote, that we focus on virtual CFO services, and we're built more of a corporate structure than we are a public accounting structure. So my role is the CEO and his role is the COO. So my role is to come up with the ideas and what we want to do and how we want to implement them. And then he then executes on those ideas. So two very different roles, but very, very important and necessary for us to get where we're at. I think if it was just me starting from scratch, I'd probably be still thinking of all those great ideas. And if it was him, he would be just doing ideas and not doing, we wouldn't be growing. So the combination of both of us together has really kind of helped us to go from no revenue in 2002 to we'll be over $9 million, $10 million in revenue this year. So a big, real high trajectory, especially over time.
So if you're using EOS terms, it sounds like he's the integrator. Correct. You're the visionary.
Yep.
Just generally speaking, and that is a combination that if you find the right person, it's explosive, as you said, you shared with the numbers there.
Yep.
I'm going to list out a couple of things that you guys are doing that I think I want to talk about just as episodes. So you're fully remote.
Yep.
You guys have implemented some form of subscription pricing.
Mm-hmm.
You're focused on a niche, heavily focused, and went really deep with that vertical. You guys have a remote team, the way that you compensate the team and the way that you have them involved. You also have the structure of the firm of the way that you have implemented new approaches for team members. And again, this isn't a question. This is just me laying out what I know already. And I'd love to talk about these topics. So the way you have data analysts and like engineers, so to speak, working with the team. That's really new for a lot of CPA firms, or just to even talk about that. That's and then you guys are very tech forward and shit, all the other stuff you do outside of that, like the media, the podcast, the AI CPA, you wrote a book, you're a thought leader. So where the fuck do we start? where do you want to start with all of these things? Because I could go on for days.
So when you were starting your firm in 2002, did you have a vision of kind of where you wanted to be, or has it kind of evolved over time?
Yeah. So when we started in 2002, I didn't want to do the traditional accounting approach. So there's a few things that was kind of off the table right at the beginning. The first thing is when I was in public accounting, we had to have suits and ties. And this is back in 2002. Everybody had to have kind of a requirement. when I worked in the corporate world, we made fun of those people when they came and we called them suits and ties. So, it was one of those things I thought, I don't want to be that person. So I thought we're going to do things a little differently. We're going to dress down, and we're not going to dress down. We're going to dress to our clients, and our clients aren't typically going to be the stockbrokers of the world type of clients. So, that was one of the big things. Another thing we thought was, we did not want to have our team work more than 40 hours a week. And that was not typical in accounting firms way back then. When I worked in public accounting, it was 70 plus hours a week during busy season. And it was horrible. And it was something I really didn't want to do to our team. So I thought, well, we got to figure out a way to make that happen. And then the third one was the hourly billing. When to get rid of hourly billing completely and figure out a different model, because I was never into the hourly billing. We still track time. We always track time, but billing by the hour, we tried it initially, and it was like, it seemed like all of our conversations that we have with clients were about our bill, and did we not itemize it, or what was this quarter of an hour, or whatever. I want to get that completely out of the equation and really help the client going forward. So there's some really the focus was just changing the way that we do things and give a different approach to accounting. Right out of the gate, realize that, hey, when we provide financial statements to clients, they don't care about those things. They don't understand how to read them. There's a lot of things that are negative about that. And when I was in the corporate world, I had a whole bookshelf full of freaking financial statements from ever. It seemed like I'd get it 3 months later. I'd slide in the bookshelf, never even open it. And I was like, well, we don't want this to be the case either. So we had to figure out what people wanted. And so in doing so, we actually started reaching out to our clients and figuring out, hey, on this monthly stuff, we turned to our tax clients and we said, we're going to meet with them monthly, and we're going to figure out what we're going to talk about. We're going to give them a financial statement. We're going to solve that first piece of the puzzle and figuring out all their issues throughout the year. So when it comes tax time, not a big deal. Tax return should be simple to put together. Well, that worked out really well, except for there's really not a whole lot you can talk about historical stuff that's really going to help a client going forward, because they don't care about that stuff. What they want to know is what it did today and how that's going to impact me going forward. And so immediately thought, well, heck, we got to show them more of a forecast, something that we can actually dynamically change so that clients can really make decisions. Because all these big corporations, they have this already built into it. They got a bazillion accountants, and so forth. And they're already putting these analysis together. But these small businesses didn't have that. And so we thought, well, let's be that person. And so we would meet with the client on a monthly basis at that time. We'd go through and show them, hey, here's what happened in the last month. Here's that 15 minutes. And then the next 45 minutes, we show them, hey, based on that, here's what your cash position is going to look like in November. Here's what's going to look like in December. Are you okay if we borrow a line of credit in October? Because that's what it's looking like, or not. And then we had those discussions. And it's like, well, they'd say, well, what if I hired these 2 employees? Or what if I increased this price? Or what if I did something differently? How does that impact? And we started modeling. Clients loved it so much. They said, you know what? Could we do this more often? So instead of once a month, and we're like, yeah, let's do it on a weekly basis. And so we changed our philosophy from going to a tax return to monthly work to weekly work. And so we started weekly work, and we had to kind of figure out what we wanted to do with these weekly work, because it wasn't going to be the show up and it was going to be the Summit show every time. I'd run out of things to even talk about. And so we had to kind of define the meetings, and we said, well, we definitely need a forecasting meeting, because that's definitely what people want. No matter what kind of service they get with us, they're going to get a forecasting meeting. Then we also said, we also need a pipeline meeting, something, especially for those clients that are service based. We need to know what their pipeline looks like so that we can say, hey, we're going to build this forecast, but their pipeline doesn't match the forecast. Well, we need to make some adjustments, because a forecast is only good if your pipeline matches it, right, or dictates it. So we needed that pipeline meeting. And then we also found out that clients do things a lot differently on the revenue side. So we needed a rev-rec meeting to make sure that when we put our KPIs together, everything lined up, so that when we had our KPIs, it was matching the story was telling a story, right? The revenue was telling, revenue and expenses were matched up. Everything was going at a nice pace. So for those cash-based clients, we converted them to accrual base, did the KPIs. And then we kind of had like a floater type of meeting to cover really any odds and ends that we didn't cover throughout the month. And so with that, clients really loved that. We defined meetings. We actually met with them. We went over the different areas of the meeting. But then additions, we had some clients that really needed cash flow issues. They were really tough on cash flow. So we thought, well, let's have that meeting every week. Let's have it for like a half an hour, meet with the client. I don't want to meet with the client. Let's let my accountant meet with that client, go through, hey, here's what the next 13 weeks looks like if these bills are paid, this money comes in and so forth. So they could see their runway on a cash meeting. So we kind of evolved over time on what the clients wanted, kind of listened to them, what they wanted, and evolved that. The nice thing about that, we were able to flat fee our service, but that was the bad thing about it too, because we almost went out of business doing it because we didn't know how to do it. We created this flat fee, and it about put us out of business completely. So we had to kind of figure out, how can we?
Was that because you priced too low? You priced it too low?
Yeah, we were way too low. Yeah, way too low. So initially, our average order was like we thought, clients are never going to spend more than $10,000 for the service. So we thought, let's price it there. And I was like, we were closing about every deal we had. It was kind of funny. We're like, we're about 90% close ratio, which is not a good thing. We want to be like 20 to 30%. We started increasing it because we found out we weren't profitable. Because we were doing all this stuff for them, kind of like the Netflix model, providing all this information, but we weren't profitable at all. And so we had to really quickly increase our prices to 20,000, then to 30,000. We thought no one's ever going to pay 40,000. Then we bumped to the 40,000. Closing ratios are still.
You're talking about per month.
I'm talking about per year, 40,000 per year.
Okay, per year.
And so then we went to 60,000, and right now we're at between $65,000 and $75,000 a month. A year that a client will pay. But we break that down into weekly payments. So the client pays us actually every single week. So we just ACH their bank account every single week for that weekly fee, whether it's at $1,500 a week or $1,750 a week or $850, whatever that is. It's a weekly perpetual fee, which is super, super nice because we don't have an accounts receivable. So we're a $9 million plus accounting firm with zero accounts receivable. Actually, we probably have negative accounts receivable if you look at it because we collect our money on Monday before the week starts. So so it kind of evolved in that manner.
How do you structure the firm as far as you've got a lot of stuff going on, tax, CFO level work, and then you've got accounting. Kind of talk about the structure of your firm and your employees.
Yeah, sure. So basically we're broken up into pods, and we've got right now 2 pods. There's about, I'd say 18, 19 people in a pod that's directly related to the accounting function. We also have a 401k audit side, which we won't talk a whole lot about, but that's about, I'd say 10% of our business. It's done exactly the same way, but it's completely different than the CFO
fixed
side.
Fees on that? Is it fixed fees?
Fixed fees on that as well. Yeah, it's between $10,000 and $11,000 an audit. They actually go to our website, type in their information, and they get a quote right away. So it's really hands off, very, very simple for them to do. So the audit side really works well with it. But on the CFO side, we have a CFO. We've got, I think there's like 4 or 5 CFOs in a pod. And with that, a CFO is somebody that's basically the account manager, the person that's actually speaking with the client on that regular, weekly, or monthly basis, depending upon the service level. Below them, they've got account level individuals between, I'd say, 4 to 12 plus years of experience. They're handling the number crunching. So they're doing the forecasting, and they're doing the behind the scenes, overseeing if the client wants us to do their bill pay, we'll do the accounting. They're overseeing that function. Then we also have a tax individual assigned to the account. So the tax person's job is to make sure that throughout the year they've got tax planners as needed, and then they put the tax return together at the end of the year. So our accountants and our CFOs do not do the taxes, and we did that on purpose because we don't want there to be any interruptions during tax season. So we've got an individual doing that outside of those individuals. And then we've got the data analyst. And the data analyst is the person that basically connects the software, making sure that if they're using QuickBooks Online, it's connecting, and maybe they're using maybe Harvest or time tracking software, whatever that might be, connecting all of that, dumping it into our database, and then pushing it up to our reporting. So once our accountants are all done with the financials, if that's what we're supposed to be doing, then we will push the data analyst push it up to the dashboarding, and then it's there for the CFOs then to give out. So we've got those folks. And then if we do the bill pay, or if we do any kind of invoicing or anything like that, then usually we have our outsourced folks over in India or the Philippines are handling those transactions. And those, again, are overseen by our accountants. So there's basically a team of 5 or 6 people per every engagement that's handling the account. So it's, everybody's got their specific roles, and works really well.
So you would in your pods, you said about 18 to 19 people in a pod.
Mm-hmm. Yeah,
and
roughly.
And 5
outside
to 6,
outside of the outsourced folks.
Yeah, and then that's outsourced is outside of that pod.
Mm-hmm.
So you think a pod So you kind of think a pod can do 4.5 million.
Yeah.
Are you kind of designing it so that each pod does that, and then like when you need, you can just kind of create a new pod when you get more clients?
Yeah. So the way that the pod structure works, and we learned this from our creative agencies that we work with, because they have very similar type of structures. Nothing that we have ever done has been because of us. We don't invent anything. We just kind of take what works really well. But what they found is that when they get to the 25 person mark, that's when the pod starts really stretching. And so between 25 and about 35 to 40 is where we, will continue to add people. And then once we get to that 40 person mark, then we'll take that 50 or that, the 10 or 20 or whatever that might be, bringing it back down to 25 to start that new pod. Because what happens is if you go to the 25 and then start a new pod, you're not going to be profitable again, because you've got all these different layers. You've got to have it. They're not fully utilized. So you've got to push them to the stream like the rubber band, and then bring them back down, and then fill that pod up. That's the way that you have to.
I love that. So how many clients does a pod have?
Yeah, so basically a CFO will have about $1 million in clients. A senior level accountant's going to have about 600,000. Yeah, so if you get about 4.5 to 5 million, so you're looking 15 clients a person. Times 5, so probably 80, 85, something like that.
I love it.
Wow.
You have got it down to a science. So
we try to.
If you have like the ERC or something like random comes up, you've got PPP stuff. Like how do you handle that with the capacity?
Yeah, so that's kind of the built-in the wow factor, right? And so during the pandemic, when we were going through the PPPs, that was just really part of what we did. So we didn't charge anything more for it. We just simply did it, for our clients. I know some of the CPA firms charge, and that's great, but that really wasn't how our model is structured. Something like that is supposed to be included in our fee. And so with that, we got clients forever, though. Our clients loved us, and it worked out really well. When you're working and you're managing a client base, and your clients and your team's only working about 40 hours a week on average, the accountants, the CFOs are working about 45 on average. It's really easy to flex up for another 10 hours or so if they need to do something like that on the PPP. And they all did. They took on the extra work during that short compressed time to handle that. Now, if they're working 45, 55, 60 hours a week normally, that would have been really tough. And that would have been something we would have had to figure out. But because we've designed our structure so that the accountants typically work about 40 to 45, CFOs work between 45 to 50 tops, it works out really well.
So you are effectively setting the expectation, managing the expectation, and exceeding the expectation all in one with the way you just described it. That's the way.
You're basically saying you're going to do everything for the client, basically.
Yeah.
So you're setting that because you're not charging extra for it. So you're not creating a situation where they're demanding this to be done. You're going above and beyond, but also setting the expectation that this will get done, and we are going to work with the capacity we have to get it done.
Yeah, exactly. So we take the engagements all the way up until the exit. So once they're exiting, then we'll charge them separately through the LOI and going forward. Because at that point there's a lot that goes in with that. So we'll take them all the way up to the LOI. Outside of that, everything depending upon the service levels they want, it's all there for them. So like if the way that our structure works is that during the sales process, we have all the different features all pointed out. Hey, here's what we'll do: rev-rec, we'll do financial sales, we'll do forecasting, we'll do accounts payable, receivable, all the different things we can do. And then the client picks what they want and don't want. So if the client doesn't want us to do any of the accounting, they say no. We don't do any of the accounting. Do they want us to oversee the accounting? Yes. They want to oversee the person they've got there? Yes. And so then we've got a very specific SOW or statement of work. We're both in line. And so then when we put our SOW together, we make sure we spell out exactly what we talked about in that sales call, so that the client knows exactly what we're not doing and what we are doing. And then when things like that pop up, then it's not a big deal. The nice thing about that is it allows the client to kind of change what they want to do throughout the engagement, right? And so like, let's say they didn't want us to do any of the tax work when we first started because they've got a tax person they've worked with forever. 6 months in, they're like, you guys are you're rocking it out here. Why don't you guys just do that too? So we can pop our calculator back up and say, yep, boom, 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 boom. Here's what we've got. Here's the new fee going forward on a weekly basis. And it's that simple. Or in a case, so let's say that we're doing all their accounts receivable, and, or maybe we're not doing as well as they want or not getting it out as well as they want. And they want to bring that internal. So we pop up our fee again, click it off, boom, here's our new fee. So now it's going to be lower. And then, they bring that internal. So we designed it so that the client has full control over what is included and what's not included in their service. So there's really no issues or no, I thought this was included or I thought this wasn't included. So we make it very clear from the very beginning.
Scope.
And we give our CFOs that transparency that when it happens that there's a change, they're responsible for making that change. We also incentivize our CFOs so that they're very profitable. And so they're not going to pull on scope creep and not charge the client because they know that if they're going to do X, Y, Z, they got to put time to it and it's going to make them less profitable. So we incentivize our team or give them variable pay based on profitability.
So I want to go back to the meetings, right? And we talk about this a lot. A lot of firms are trying to figure out advisory. A lot of them do this on an hourly basis because they can't define the scope up front, and it just gets very variable with the client, and they're letting the client dictate this. What you've done is you've productized and created a cadence for every type of meeting that you could do, and you've almost basically got it down to a science.
Yeah. And we failed several times. I mean, it took us about 10 years to figure this out. So these firms that are trying it right now, they're experimenting as well. And unfortunately, they'll see failure a lot because of the fact they just don't know how to present these meetings. And hourly charging by the hour is definitely not the way to go. Clients don't want to be charged by the hour. They want to know what the fee is up front. They, just like everything else.
We know the issues of hourly billing. Trust me. And I've almost resorted because of
we don't charge by the hour. Except Scott might, but
no. So what you just said, we track time and we do everything as a fixed fee and we price everything up front.
Mm-hmm.
I am figuring out that there are some situations where, because we were not very profitable this past year, and I'm trying to get back there. And the easiest way to get there, I think, is billing hourly, and I don't want to. But there are some things that we can't define the scope yet. I don't know. We don't. This isn't a conversation about that.
It sounds like you have a niche. So what's the niche market that you guys do?
We focus, I'd say 50 to 60% of our business is towards creative agencies. That would be service-based agencies. And in the digital space, they might be like web design, web development. They might be SEO, SEM companies. They're typically over $1 million in revenue on the small end, and our average client's about $3 to $5 million on the average. Our biggest client's like 30 million, but we don't have too many of those. We got a couple of those, but nothing on the big side.
So here's a trend that I've seen too, or at least that I've been modeling in our firm, is our clients mirror us, right? So your clients, professional services, 3 to 5 million range, you're above that, but you know how to service that because that's you. They're a reflection of you.
I think I think you've found a niche that you like to do.
Right.
And that niche so well that you can fix price it up front because you kind of know all the different ins and outs. And obviously every client's different, but
but you can relate to them. You learn from them.
It's a vernacular, right? So I know the vernacular is that industry, but I didn't know when I first started, right? Our very first CFO client was in the creative agency. From there, I learned a ton about that client. They're actually fully remote too. So they're one of the first distributed companies in the world. And we got them as a client. It was really fortunate because I learned a lot about the remote side. And I also learned about how they ran their company, and which was very similar to an accounting firm. It was they track by the hour. They bill their clients on an hourly rate. Utilization is important. I could easily break down how to be profitable for that type of client because it was the same thing I was doing in my own firm. So it was really simple to go over. Now, if I were to jump to construction, it wouldn't be that much different either because it'd be really similar to figure out, what's profitable, what are the drivers of revenue, how do you calculate WIP, all those different things would be very similar. And if I start focusing on that, it would be it'd be no different than the creative agency. It's the fact that was my first opportunity. I loved it. It was really easy to speak with. They were my type of people, and I could relate really well. Whereas a doctor organization might be harder for me to relate to because we're completely polar opposites. I As I mentioned earlier, I was the first one to grow up with a degree. I'm not from a family of wealth. I'm not used to hanging around doctors and lawyers and that sort of thing. So it would have been a different type of practice for me, or different. It would be a step up for me, but maybe for you, maybe not different. Maybe that you've got a construction family, or maybe, there's something that you really like or are really passionate about or really have a good feel for. It could be dentist. It could be, a brewery. It could be really whatever. There's a lot of different niches out there that you could have easily went to and easily figured out. And I think once you do figure it out, you've really got to go towards it. It's kind of funny because we talk about niches a little bit. We didn't really see our growth until we niched. We did the CFO service from 2004 to about 2011. We were picking up probably 2 to 4 clients a year, and we're high-fiving each other, and we're like, woohoo, we're doing really well. In 2013 is when we actually 2011, we got our first creative agency. In about 2013, we started getting the flow of, hey, this is kind of fun. Then we started doing speaking engagements and really started focusing on that niche. And it went from 4 a year to we picked up like 11 in 1 month, and the next month was followed by 6. I thought we were going to go out of business. It was so many clients. It was like, oh my God, what are we going to do? Is it going to be like this forever? Thank God it slowed down. And now we do about 4 clients a month, at about $60,000, $70,000 a client. And so it's really gone from a really slow market to a very high speed market. And it wasn't necessarily because we niched our service, but it was because we niched into an industry. And, again, that's comprised of over half our clients, probably, like I said, half of our clients. We got about 150 clients that we work with on a regular basis on a $9 million firm. It makes it really super nice. Now, do we turn away clients in other niches? No, we don't. It depends upon the niche. Like a manufacturing client, we'd probably turn that away, or a nonprofit client, we'd probably turn that away. But there's a lot of them that we can pull our experiences from the one and use towards the other. Like we mentioned, like breweries or really anything else that's service based would be we'd be able to fall in to handle that pretty well. But again, the focus, our marketing efforts are towards one niche.
So you say you don't turn clients away. Do you have specific pods that handle different verticals, or have you structured it that way internally?
Yeah, so we're moving towards that right now. So we've got 2 pods, and so the third pod, we're thinking about spinning it off and really focusing on an additional vertical. We haven't really identified that. We'll probably go back through our client base and see which client base where we have the more concentration in, whether it's construction or something else. We'll break that out. But that's really kind of the next step in our evolution, is going from one vertical and maybe going to 5. So
do you tailor your prices toward the vertical now when you take on different clients, or are you using the exact same pricing model for all of them?
Yeah, well, see, our pricing model is designed so that we're profitable. And so It's kind of selfish, but we try to maintain a 72% profit margin on all of our clients. And we tell our clients the same thing, 1/4, should go to the expenses, 3/4 to the direct, gross profit. Then it all weeds out to eventually you're down to 25%, margin before owner comp, that type of thing. So we kind of rotated around the same manner. We deal with the same thing. And so if we were going to go to like a different model, we would probably change our pricing a little bit because maybe instead of rev-rec, maybe we're doing WIP reporting for construction, or something a little different geared towards that industry that's important to the industry. And we'd kind of figure out how important it is to that industry, and that's how we would actually price it. So we kind of look at our base dollar amount on what's our break even if we were to actually do it, and then we add like a 10 or 15% air margin, and that's our bare minimum. And then we look and see how important that is, and then we increase it multiples based on that. And so
value. So you're value pricing it before but your value-based fixed pricing, which I think is beautiful. Like it's so scalable. Yeah, it's
100%.
You don't have to pick a price for each person based on what they want. You've got it, and what's profitable. Yeah, I love it. I love it.
And there's 2 factors that really make a difference there, because $1 million company is a lot different than a $10 million company. So you've really got to scale it based on the size of the company. And we also scale ours based on the number of employees. So there's 2 different factors we use to scale company-wide, size-wise. And we tell clients that. We say, hey, $1 million. And they're like, well, when we get you to that $3 million mark, here's what your fee is going to be based, roughly what your fee is going to be. We'll bump our scale to 3 million and be like, oh, so it's going to be another $50 a week or whatever. It's like, okay, that's pretty reasonable. So it's not a significant jump, but it is once they get to the $10 million mark. $30 million company is a lot different than a $1 million company. You're talking about completely night and day difference on what you're doing. So it's important to have it scaled based on size so you don't get pigeonholed into a flat fee that doesn't work.
So you've got 2-factor, eventually maybe it's 3-factor. So it's like 2-factor authentication, revenue and employee count.
Yep.
3-factor would be revenue, employee count, and industry as you get to the 5 verticals.
Sure.
Like
Absolutely.
That's
oh,
that's so cool. And you're using just a spreadsheet to come up with you've got your like all the details in there, and it's just
it's a spreadsheet we put together. The nice thing about it is when we're on a client call, all of our client calls are done remote. We've never done one in person. So it's completely through a video conference just like this. We'll listen to what they have to, what their issues are at the beginning. And then as we're going through, by the end of the conversation, we pull our spreadsheet up, which we call our pricing calculator. We go through and based on this, the client picks their own experience there, and then they've got the price right there. So they know exactly what it's going to cost if they want us to do their taxes versus, having their current tax person. If they want us to do some of the accounting versus having their accountant do that or bookkeeper do that.
And so it's out a weekly price.
It's
right as you. Oh God, I love it.
Yeah, client love. They love it. They have. It's kind of like the Nirvana experience. Is it Nirvana with the car place?
Carvana or something.
Yeah, where you type in, your car comes, popping out. And it's the same type of experience. The client picks and chooses their solution, which is completely different from one client to the next. I'll talk to one client, it'll be completely different. Next prospect, completely different, and then both they come up with a price that actually is profitable for us and makes sense for them. I've never had a client not leave a prospect call and say, "Wow, that was cool. We might not use you guys, but that was pretty cool. I appreciate you being so transparent with your pricing." They love it.
And you're not messing around with options or here's your 3 prices to choose from. You're really just telling them, this is what you said, this is what we suggest, this is what you need. And you got the freedom to
their options are they do have options. Their options are one, transactional, which we're not going to talk anything about the forecast in the future, which is what a typical accounting firm is now offering. And I'd say maybe 10% of our clients have that. Not very many at all. We probably picked up 3 or 4 in the last 5 years. Outside of that, then it's based on the touch. So do we want a monthly touch or do we want a weekly touch? A monthly touch, we call it controller level. You could call it green level. It doesn't make a difference what the name is. And then the weekly touch, we call it CFO level, and you can call that blue level. I mean, we just named it. I mean, we just put a name on it. Doesn't mean
you're using colors.
Yeah, you can name it gold, silver.
I love
colors.
Colors.
So
you can do any of that.
And colors and numbers.
So basically, your monthly versus your weekly, and that's what we're trying to decide during the call. What makes sense to them. And I'd say a company from $1 million to $3 million probably just needs a monthly touch. Probably doesn't need anything more than that. At $3 million, that's when they start really getting their board level people. I'd say board level, like their CEO, marketing person, production person, whatever that might be. And so there's more people involved in the conversation. And so we are part of a leadership team meeting at that point. And so it becomes like a weekly touch. And so it's monthly versus weekly. And that's kind of what we're trying to decide while we're listening to their conversation in the first one.
Script 2, the fun version. ...
Accounting is all about numbers, right?
No.
But here's one that should get your attention. 420. Whoops. Sorry. This is designed for you, Scott. 420. Sorry, read that wrong. It's $349. That's how many dollars Gusto's People Advisory training usually costs. But because you're a listener of this podcast, and surprisingly, you've made it this far, so God bless you. Gusto's offering these valuable online courses free for a limited time.
What's People Advisory, might you ask? ... It's essential training for accountants looking to move beyond payroll and help clients protect their business, work more efficiently, and strengthen relationships with their employees. It's also a great way to maximize revenue for your firm.
Let's face it. Today's business owners need more than just bookkeeping advice. By taking Gusto's People Advisory Certification Accelerator courses, you can offer so much more and charge for it too. Did I mention participants can also earn 9 CPE credits? I can be forgetful sometimes because I think this was designed for you to read. Because
definitely designed for me.
Because you're literally high right now reading it.
So and literally To access your free people advisory courses, head to gusto.com/training and use code SONS100 at checkout. That's gusto.com/training with SONS100 at checkout.
Use the code.
Use the code, people. Use the code. Use the code, people advisory. Because this time you don't have to scream it from the rooftops either. You can type it in.
Yeah.
SONS100. Type it in quietly. Gusto.com/training with SONS100.
That's beautiful. So how do you're performing a bunch of advisory services. Mm-hmm. How do you get your employees and team like trained properly? Because it sounds like they're doing, they're not doing a lot of low end work. Sounds like you send that overseas.
Right. So the accountants are fairly simple because they're basically putting together financial statements, things they've already used to doing. So a brand new person coming in that wants to be an accountant for us, it's not going to be a ton of difference on what they would normally do. The only difference is now instead of doing it for one company, they're doing it for 10 companies every single month and so forth. The only client-facing part that they truly have is that they run our cash flow meetings. So our accountants will do our cash flow meetings in which they're meeting with the client for maybe half an hour a week, going through ins and outs of their cash flow over the next 13 weeks. And so it's fairly simple to teach or train those folks because a lot of them already come in with that experience or can handle that type of thing. We typically don't hire people from 1 year to 4 years because they don't have that experience coming to them. So we're looking for 4 to 12. The CFOs are a little harder. Now, a CFO isn't what you call a traditional CFO, I would say. A CFO is somebody that's going to go over the forecast with the client. They're going to meet with the client. They're going to bring in the marketing. They're going to bring in, they're going to ask, get all this information from all the people to really present them with solid financial forecasting, going forward. And with that, it takes a special person because it's not a typical accountant. A CFO is somebody that can actually talk to people, that can convey messages, that can read people, that can understand, and really create that conversation. And unfortunately, a lot of us accountants can't do that or don't feel comfortable doing that. It's outside of the box. Whereas a CFO, they do feel comfortable, and that's what they want to do. So they want to be that teacher. And it's a little different because when we bring new people in, they go through a training seminar. We've got a 13 video episode kind of going through, hey, here's all the different steps that we do, here's how we work with the client, here's what we do, here's how to do a forecast and so forth. And then they tag along with another CFO initially, so they're listening and watching that CFO, and then we put them on the client pretty quickly after they've come aboard. And then we sit and we'll have them videotape it. We'll review their call with the client and give them feedback. And so it's a pretty in-depth process. And we're always looking to make sure that we're delivering that same brand message from one CFO to the next. And that's kind of tricky coming out. So we want to make sure that's not a typical, I would say, accountant that's delivering that, but we want to create that accountant that really enjoys speaking with people and going outside the box. A lot of firm owners are that way.
Do a lot of the CFOs, do they come from the accountant side of your firm, or are they mostly like you kind of see that as two kind of completely different skills?
Well, some people, it really depends. Like we've got several CFOs that have come from, they started as an accountant and they moved up, and that works out really well. Some accountants that don't want to be a CFO, and that's cool too. We got a place for them too. So we don't push them. That's not like they have got to go to that next level, but we do hire some that actually have that skill and can move up. However, the majority, because of our growth, we're growing about 35% annually probably since 2010. And so it's a high growth. We don't have the time to groom everybody up from internally. So we've got to hire outside for a lot of our CFOs. And so we're looking for those folks, they don't have to be 30 years of experience or anything like that. They could be, 5-10 years of experience, that they have that ability to actually speak with people, because those soft skills are the number one thing that we look for with a CFO. We expect or kind of assume they understand accounting. And, it's just that ability to talk to people. That's the big key.
What are roughly how much do you pay an accountant versus a CFO roughly?
Yeah. So an accountant, so it's kind of neat. So our accountants come in really depending upon what their experience level is. So it could be 45, it could be 95. Really, there's a huge variety. So we try to bring them in there. And then then we give them what we assign them what we call a base pay. And so in addition to that base pay, they get a variable pay based on the size of their business. So, if you're coming in at, let's say, a junior person, maybe 3 years of experience, and let's say you're at $60,000. And so let $60,000 is your base pay. And we give you a range, hey, based on that, here's the minimum book of business that you need to be managing. But you know what? If you're a rock star and you want to manage more, here's how much your pay is going to be. Here's your variable pay. Here's how much that's going to be to make up for that. And we design it in a way that someone coming in low and someone that's been there forever can make the exact same amount of pay. Part of it's going to be base and part of it's going to be variable because it's all based upon their size of book of business. So if they're managing an $800,000 business as an accountant, they can make $100,000. Doesn't make any difference if they got 3 years of experience or 4. If they're managing well, they can, their variable pay will make up for that difference. So it kind of puts everybody on a very equal plane, and it takes away all kinds of discrimination. So we don't, on accident, we don't hire a woman lower than the man, not thinking about it and paying her lower forever because she's always been lower. No, from the very beginning, it doesn't make any difference what you come in at. We don't care. It's, hey, here's what we need you to perform at, and boom, you perform at that level. You're making at the highest level that we can make in the company. And again, it puts everybody on the equal plane. Similar type of thing for the CFOs. They start out at $125,000, and with that, they can make variable pay of up to $80,000. So they can make over $200,000 a year based on, again, their book of business. If they want to cap out at $600,000, not that million, that's fine. But here's what they're going to get paid. So their pay, again, it fluctuates based on the book of business they're having, which makes it nice because then it can go up and down. So someone at the $1 million mark might go into a situation where maybe they're in a pregnancy or whatever, and they need to slow it down for a little bit. They can come back down. Their variable pay comes down with it. So it's not like we're paying them this dollar way up here, and now they're performing down here and we're losing money. We're paying that base pay, and their variable pay comes down to where it is, and they can kick it back up once they want to bring more clients on, or once we bring more clients on, or they want to increase their book.
Is the variable pay effectively just a reposition of a bonus, or is it okay?
Yeah, pretty much. Yeah, you can call it a bonus or whatever you want to call it. It's based on the book of business. So we base on the size of the book.
So you kind of mentioned earlier, like your profit percentage, but so the firm's profit percentage is 28%?
No, 72%. So the gross profit percentage of every client is roughly 72%. Now, we do have those that are 80, 85%. We have those that are 50%, but the average is 72%.
But gross profit means, so what does that mean?
That means revenue minus the direct cost, the hours put into it by the team. So direct team costs.
And you're using those hours based on team pay, cut down to hours and the time that's being spent. And then afterwards, you've got your overhead.
Yeah, so overhead's outside of, yeah.
So that includes their variable too?
So we try to maintain a company gross profit of 50% across the board. And that would include, so what's above the line, everybody's pay, no matter if you've got it working on a client or not. So they're 100% of their pay. And then the software costs, any kind of technology or stipends, any kind of benefits and so forth. We try to maintain right at that 50%. So if you get a 50% gross profit, we know that we have 25% admin costs, and then we have 25% operating costs before owner count.
Okay, so basically the firm before owner, so the owners are bringing in 25%.
Correct.
Mm-hmm. Roughly.
There's just two owners?
Mm-hmm.
I know, yeah.
Oh, wow. It's kind of cool.
Good.
I mean, so
tell us, so everything you've done is awesome, and we know you've made a lot of mistakes along the way, and that's how you learn. Mm-hmm. Tell us kind of like a couple secret sauce things that you think like really helped when you were kind of down, because it took you, sounds like 12 years to kind of so what were like the big key learning things you learned along the way that have made you so successful now?
The biggest one I would say was how you price the product. So when we priced it off initially, and I'm on the board of directors of the DCPA, and so I see what the average CAS practice is doing, and it's like, oh my gosh, why would you even put that in there? I'd be so embarrassed to charge that low, because you can't be profitable. And the problem is, and that's what we had, was we did our fixed fee and we're like high-fiving it. We're thinking this is great. And now we're stuck because you can't go back to a client a year later and say, I screwed up and you should be 4 times as much as you're making, we're going to change your price by 4 times. That's not going to work. And so I think the key there is that you've got to figure out the pricing from the very beginning. And it took us a long time to figure that out because we always undervalued our stuff. We thought, heck, we can do this really quick. And again, that hourly mentality, no matter we were doing fixed fee or not, we were still at the hourly mentality. And it's like, no, let's switch it around and say, hey, what are we replacing? So we're replacing part of an accountant, part of a tax person, part of a CFO, and kind of backing into it in that way to determine pricing. And then kind of comparing it to what you've averaged on the past, taking all your numbers in the past and figure out, well, how much time does it really take to do cash flow meetings? It takes 4 hours a week or whatever it is. So we need to have that as our bare minimum. We can't charge that. That's got to be our bare minimum. And then we've got to add the value on top of it and figure out what's important to the client. But the key there is, again, don't underprice the product, because you will get yourself in a situation where I just talked to a guy, he had 750 clients and he does about $6 million in revenue. Which firm would you rather work for? One with 750 clients at $6 million, or one with $9 million in revenue and 150 clients? It's completely different, because now our team can be focused on a smaller amount of clients, highly profitable, and be able to deliver a very solid service for them versus a firm that maybe has 80 clients or 60 clients a person. And, maybe they don't touch them as much, but they're going all over the place, pulling their hair out. And you can kind of see where my hair went, but pulling their hair out because of all those issues that they've got coming up. That's, all these different distractions they're going through. So that's a big thing I would say is pricing a product, pricing a service, and just adding a big, huge addition to it. Whatever price you come up with, go a little bit higher. Because you're going to find that when your closing ratio start to get to around that 20% closing ratio, that's when you've got a pretty solid price. Ours is right now, and I say that we're averaging $60,000 to $70,000 a client. Our average is still at 40%, so we're still closing about 40% of our clients, which again tells me that we're probably still a little too high. Or too low, and maybe need to increase a little bit more. But we're kind of holding for right now and seeing how that goes. But, it is what it is. We will close about 30 new clients a year, 30 to 40, somewhere in there at 40% closing ratio. That's where you want to kind of build your practice. So you're not accepting a bunch of small clients that are just going to kill you over time. You accept, the little bit bigger clients, and you really kind of manage the bigger engagements a little bit more.
How do you spend your time?
I spend my time on podcasts like this. I spend my time, actually, I'd say probably 60%, 70% of all the prospect calls that come in, they come in through me, and I handle those typically. I spend my time in meetings with the directors. I bill about, I'd say 5 hours a month, probably tops. And what I mean by billing, I'm attending 5 different client meetings a month, and those are, well, my wife's one of my clients, so I got to attend that meeting, and then 4 other friends, and
He's probably the worst client.
Yeah. Oh, yeah. Friends. Yeah, that's a death client. Yeah. So
it's clients that you've had a relationship with over time.
Yeah, and forever.
You don't want to let go of that relationship personally, probably.
Yeah, and I don't do any of the work for them. So I see accountants do that underneath, and I kind of train the next possible CFO. They'll be working on the account, and they'll hear me talk to the person, and they'll kind of hear what's going on. And so it's kind of a training ground I use it for. I probably will never get rid of those 5 clients until they sell. It used to be 7. 2 of them sold this last year, so now I got 5. So kind of a fun time. So the rest of it is just simply working on my business there, making sure that everything's going well.
Design your firm and design your life at the same time. It sounds like all of this stuff happened by design.
Yeah, I'd say design and luck. There's a lot of luck that goes into everything, but the other thing is just taking advantage of that luck. Opportunities are always going to come up, and you just be able to pull the trigger.
Yeah.
For a firm that's kind of starting out on this journey, kind of where you were in 2002, 2004, other than you've told us pricing super important, kind of give us a couple other little nuggets.
Man, I got other questions than just.
I know, but he might have to do something else today.
Oh, I can talk as long as you guys want. I would say the biggest thing is, because we have a lot of firms that go through our program, because we've been teaching and trying to get firms to make this conversion probably for the last 4 or 5 years. And I've been going to different seminars, kind of teaching them how to do it, which is kind of weird because, it's like an accounting firm teaching you how to be successful, and here's how you do it. It makes a lot of sense to us, because the more firms that are out there doing what we do, the better it's going to be for everyone, because it's going to mean it's becoming more of a norm. And and then there's more for everything. It's kind of like the Burger King and the McDonald's. When you stop, when you're driving down the road, you see one Burger King right there at the stop. You tend to, I'm gonna pass it because I see down, maybe three miles more down the road, there's all these different restaurants, and so you pass that one Burger King and you go to all these different restaurants, and guess what? You end up going to the Burger King at the other stop. And it's kind of the same. It's the same philosophy, because when there's more out there, it becomes normal for clients, and that's what we want this to become normal. So what happens with these firms? So kind of backing up. So we want this to be normal for everybody, and so we're teaching firms how to do it. And what we see is that a lot of firms will go through our course. They'll figure things out. They'll think, this is great. I love this idea, but they never do anything. And because they want to be perfect. And I would say the biggest thing is, you're never going to be perfect. Just do it. Just start. I mean, when we started, we had no money. I mean, I didn't have a big, huge wad of cash to start a CPA firm. I started it, bootstrapped it. I did what I had to do to figure out how to get there. When we went to the subscription-based model, it wasn't because I was a genius and thought, oh, this is great. It's because I had money. I could be the bank. So I had to figure out a way that we could actually provide this service and not be the bank. And clients loved it. We just zapped their money every Monday. They love that. I mean, it wasn't a pushback. It wasn't, the fear was, oh, no one's going to want it. That fear, you got to get that fear out of your head. Just kind of push forward towards the fear. So I would say the biggest thing is just doing it, just starting it. Just making it happen. Don't be afraid of the outcome. Don't let your own fears justify the end there. This is the perfect year for everyone to increase their pricing. And it's because, staffing is short, inflation's starting to kick in, employees, the great resignation is causing everybody to make sure that they pay their employees more. Well, this is the perfect time to increase your pricing this year, maybe a little bit more than what you would normally do because of all of that. Don't let all of that decide, well, the clients are never going to pay any more for it. Well, they have to, because you've got to keep your profitability there. Otherwise, your service is going to go down. So price your product accordingly and increase your prices this year. So all those kind of fears, people are thinking, hey, clients are never going to want to do that. They won't, because you'll never offer it to them. So, don't be that person that's not going to do that. And then that client comes to me and says, hey, my accountant's great, but you guys know what you're doing and you're doing it well. And we want to pay you, not $20,000 a year, but $80,000 a year to have us do it, when you yourself could have done that yourself. You didn't need the client to go to me to figure that out. You want to keep that client yourself and provide that service for them. So I would say that's probably the biggest thing, is just simply going out and do it. Don't let them go to me or another CFO firm. Do it yourself. Figure out how to work it out. And if you have any questions about it, give me a call. I'll be happy to talk to them and help them out with that.
I feel like it's patience and perspective over perfection.
Yeah,
that's what I worked out based on what you said. Like, it's never going to be perfect. So have some patience to experiment with stuff and figure out what's going to work.
Perfect. They try to do everything perfectly.
Yeah. Mm-hmm. But in the perspective, the longer game and the longer perspective on how is this going to, what's the downstream impact of not doing it versus just doing it? Like, what's the worst that could happen if it's not perfect?
Exactly. I think you summed that up perfectly. Yeah, that's, and it's a bummer too, because everybody can do it. It's just a matter of, do they want to take that risk? Because it's a risk. It's different. It's fear of failure.
So you got 3 podcasts and you got this firm's program. Tell us how maybe a firm or listener could, if they want to join your program or what they want to listen, like what would you suggest of your platforms?
So we've got 3 podcasts. One talks about our 401k audits, which again, we do we do about
that's 10%, interesting.
10% of our revenue on 401k audits. Yeah. For those that enjoy audits, that's perfect for them. For me, it's not. I don't enjoy audits, but the other 2, we have a podcast designed specifically for our niche, the creative agency space. And then the third one is for accounting firms like your listeners here that can really kind of help or figure out ways to get into the CFO side. And so we really talk extensively, bring guests in, all that kind of stuff for that. A lot of that is you could probably, without even, spending a dime with us, which you could probably learn so much from those podcasts. And we do a ton of webinars also. Every month we put on a webinar on a different topic, from pricing to marketing to you name it. We just kind of open up our book and explain how to do this. And you could probably, without, like I said, without paying anything at all, you could probably learn enough on there to really kind of kickstart your business. And so if you want that extra help and you want to go through our 13-week course, we'd be happy to. Hop on our website and sign up at www.summitcpa.net. And we'd be happy to help you in that regard. But I would take advantage of all the free stuff before I would do any of the paid stuff. Because like I said, you could probably gain a lot of information from there that would probably help you and steer you in the right direction.
So the Modern CPA show is the one that a listener could listen to.
Yep.
Slide a link for the show notes. Wow. So how about the books that you've written?
Yeah, so I've got 2 of them. Like I was telling you earlier, they were probably the hardest things I ever done in my life. And you think about that, building.
I could imagine. Firm,
hardest thing was writing a book.
Talking's easy, right? Talking's easy for you. You can talk all day, but fucking writing.
Oh, geez, I could talk forever. That first one I did by myself, and by being by myself, I wrote the chapters by myself. I did it from scratch. Never written a book before in my life. A lot of articles and everything, but never a book. And then I had. I got to a point where I thought this is perfect, and I sent it to an editor, and then she marked it all up. I thought, wow, how imperfect it actually is, after my perfect version. And I thought, you know what, that person needs to be my marketing director. So I hired her. And she became my marketing director out of that, which is kind of funny. And that was a book towards the creative agency space. And after I read it, I liked it. Thought, this is a pretty decent book. And then the second book was more towards the accountants, how to become a CPA firm, a virtual CFO firm. At that point, it was from, the tagline was from, $500,000 in revenue to $5 million. And that was like 2 years ago. Now we're closing to 10 million. So it's kind of, it's kind of, the expansion.
You do $1 million to 10 million is your next follow-up book, right?
Yeah. I had to do a follow-up on that 2 years later. So it's kind of funny, but that one was a lot easier because I had her just ask tons of questions, and she really kind of helped me write the book, which was really nice. So she would ask tons of questions in my own words, and she'd write it, she'd transcribe it. Then I would look at it and say, I really do speak really poorly, and I'd change it around, and we'd mold it to the book that we had. And it was it's a pretty good one there. It's called Building the Virtual CFO from the Cloud. And then the first one was Digital Dollars and Cents. 2 different books. Both were probably the second one was a lot easier than the first one, but by far the hardest things I've done.
Did you learn a lot about yourself writing those, and then did it make you a better speaker?
Oh, it did, for sure, because I took a lot of the material from my speaking engagements and I pushed those into the book, and vice versa. And so it came both ways. And so there's a teaching component, right? So when you teach people how to do things, you really learn a lot about that. And that's what the big thing about the speaking engagements were. And that really helped me again for the book itself. And so you learn a lot about things that you say, that just different ways that you're speaking. First of all, you learn there's a lot of things in there that you can kind of change, and a lot of things that you can kind of improve on, which everybody thinks they speak really great or not great. I was horrible. And with that, it was pretty obvious when I wrote the book. But it put everything in a good mindset, and so that I could then use those materials again to speaking points and different, speaking engagements. So yeah, I would say I learned basically how to speak to people, which is a little different than how to write to people, I guess, if that's how you're supposed to say it. But both were definitely enlightening.
Yeah, I asked that because I have learned a lot since doing this podcast. Like I've learned how to listen. And it was terrible listener. Terrible listener.
Still working on that one.
Yeah. I have learned a lot. I am maybe 10% better than I was, and very far from where I should be.
I'd give you 20%.
I think you're doing a really good job, personally.
Thank you. I'm trying. So, and I did want to touch on how I love the team page. You have the caricatures. It's a little bit similar to the way we did our podcast. I did little pop figures in there of us, but and our team pages are fun. I think Ackerman's has some pretty fun aspects of it. Ours is, but yours takes it to a different level. And you've got the caricatures of everybody, even you guys, and that's really cool.
Oh yeah, we
wanted to mention
we've been doing that from the very beginning. Really, that was something that we want to be a little different again. We want. Because when you looked at a website of a CPA firm way back then, and it has, some of them have changed a lot. You could tell this is a CPA firm. With ours, we wanted to be different. And I think that idea attracted a lot of prospects to it. Hey, these guys look like they're different than a traditional firm, and then they call and we are, and so that was the cool thing. But we did that from the very beginning.
The branding too, like a lot of firms don't go by a name. When did you switch to Summit, and Did Indiana allow that? Like, what was the issues there?
We did it right out of the gate. So I didn't want my name associated with the company. So I wanted it to be bigger than Grunden CPA firm or Grunden and Hale CPA firm or Hale and Grunden. I wanted it to be something bigger. And in Summit, I thought this is really cool. Summit's actually a nickname for Fort Wayne, the Summit City. It's kind of weird. You wouldn't think of that in Fort Wayne, but I thought, well, I'll take that as kind of my name, Summit CPA. And I thought, let's add a group on there. We got a group of 2, and so we started with a group, and it just kind of gave that, it gave that bigger than, 1 or 2 person shop. And it just kept growing and growing and growing as we grew as a firm. We really filled it up pretty quickly. And so that was the whole idea, is to make, because I wanted to attract people because of Summit, not because of Jody or Adam or anybody else on the team, because I wanted it to be more brand, company brand name versus partner brand name. We're partners. When partners of a CPA firm, they're the rainmakers, right? They're the ones bringing all the clients, and that's the traditional method there. Well, I didn't want that. I wanted people coming to us because of Summit CPA Group, and we do have that. And so all the prospects that call, we don't do any kind of outbound marketing. Everything is inbound. People are coming to us for the service, which is really different than a traditional CPA firm where that partners go out and they're at the country club or they're at the the Chamber of Commerce meeting, whatever. We want to avoid that because I didn't enjoy that type of thing. I wanted them to come to us, and so we had to create that brand awareness. And so we did that from the very beginning.
Yeah. It makes things effortless when you try to re-engineer and reverse engineer things that you don't want to do it this way, do it differently. I think you've achieved that with Summit, and to a large degree, the name of this podcast has neither of our names on it intentionally, right? Like, I don't want it to be associated with, we say it in the intro, but definitely I don't want
tons of CPAs.
Yep.
Yeah. That has nothing to do with our name, right? Like, so
I love it. Yeah.
I'm changing my last name to Sons. You've been amazing. We're gonna have to have you back because I've got a lot more questions on how you run the firm.
Yeah, for sure. I'd be happy to come back anytime you want.
I appreciate you taking the time. Yeah.
It's amazing what you've done, and real inspiration for a lot of CPA firms.
So is there validation to the way I started this when I said everything that he's doing seems perfect to me?
I think it's pretty...
it's funny that I use the word perfect too. I say that.
Perfect through trial and error.
Irony. Yeah. The irony of me. Yeah. I think I'm going to call this one.
It's really cool what you've done.
Patience over perfection, or perspective over perfection. I think.
Well, and I think what you've done is you focused on the client. You made servicing the client the most important thing you do, and kind of priced around that, so you make lots of money, and then that's how you serve the.
You have a high team focus too, though. Like client and the team. Yeah. Reversing, it still takes care of you too, because you got your bottom line looking out for. You said selfishly reasons. This works out for your bottom line, so you've got the bottom of the Maslow's hierarchy worked out, and then everything else is feeding up into that. So
and I wish I could say I started that way from day one, but it wasn't. It was a lot, like you said, it was a struggle, and it was probably a lot of the struggles that a lot of firms right now are having that we had during that time. And hopefully, just by hearing what I've said and what we've talked about, hopefully that helps them kind of get, maybe knock 1 or 2 of those years off, or 3 or 4 of those years, so that they don't have to go through what we did. But the perseverance was always there. My wife always said, "You always tell me next year is going to be the year," and then next year comes, there's always something that jumped into next year. It's like, oh, it's going to be next year. And finally, after a long time, the years have come. So last 3 or 4 years have been really solid for the firm.
Patience, perspective, perseverance, and positioning. Oh, I can kill it with these
7 P's.
Yeah.
Jody, you've been amazing. Thank you so much.
Jody.
We'll have you back.
Yeah, thanks, guys. Appreciate it.
Wow, what a great episode. And wouldn't it be great if you could earn CPE credit for that? Now you can. Visit earmarkcpe.com to sign up for free and earn free CPE credit for listening to this show. That's earmarkcpe.com.